a further liquidity crunch, which could bring gold momentarily down below these $3,900, $4,000 lows. But if it does, we can see that it's being triggered by the banking system or something in the financial system. We'll know that the Fed is already acting. We're only going to have one more financial crisis until the dollar is printed to death into oblivion and inflation overtakes everything into hyperinflation. Potential bottom here, and it doesn't look like gold is going any lower. It could possibly, I just don't think so. We'll see what happens. I'm prepared for either way. That first, gold tends to sell off or correct, and the stackers and other people who own gold and other real assets will restructure the capital structure of the planet, and it's going to be the biggest transfer of wealth in history. We have here for 7 months, gold was predicting some kind of a liquidity event in the 7 months leading up to that event on September 28th. Gold only crashed for about 11 trading days during that liquidity crunch. So if we can bifurcate this, right, this is the gold correction leading up to the crunch. Well, I've been saying that I think gold is around an intermediate bottom or some sort of bottom over here, having corrected about 30% from the top of about $5,600 an ounce on January 29th, 2026, I believe it was. And so if we're around a bottom now and we haven't had a liquidity crunch yet, wouldn't you think that the liquidity crunch would bring gold down even further? So this isn't really a bottom. And I thought that was a pretty legitimate question. So in order to answer that, I'm going to divide. I'm going to bifurcate correction and liquidity crunch into two. And you might think that's unfair, but once we go into the history of how liquidity crunches affect gold, you'll see that first, gold tends to sell off or correct a little bit, and then the liquidity crunch brings it down just a little bit farther, but very, very quickly. So what I see happening is some kind of a banking crisis, some kind of a financial panic, could be triggered by some kind of energy war in the Middle East, or the destruction of energy infrastructure among the Gulf states by a giant war that's probably already happening right now as we speak. Who knows if it'll be followed through with the destruction that I'm hinting at here. But it could be something else. It could be any number of things. None of us know. But my basic theory on the endgame investor is that we're only going to have one more financial crisis until the dollar is printed to death into oblivion and inflation overtakes everything into hyperinflation. And then once that happens, everything that is attached to the dollar, including all of its derivatives, including Bitcoin and all cryptocurrencies, those go to near zero value, and all of purchasing power.
Is the biggest buying opportunity for gold and silver about to appear? Or is another sharp sell-off still ahead? Gold and silver have pulled back from their recent highs, while investors closely watch Federal Reserve policy, central bank gold buying, and rising geopolitical tensions. Against this backdrop, precious metals analyst Rafi Farber believes today's correction could be following the same pattern seen before the 2008 and 2020 liquidity crises. Could one final shakeout happen before the next major rally? Let's break down Farber's latest analysis, the historical evidence behind it, and what it could mean for gold and silver investors.
All of liquidity goes back into gold and silver where it was originally. All the stuff still exists, just the purchasing power shifts, and the stackers and other people who own gold and other real assets will restructure the capital structure of the planet, and it's going to be the biggest transfer of wealth in history. So with these slides, we're going to go into the liquidity crunches of the past in 2008 and 2020 to show you how it's plausible that gold could bottom here, and I think it will. Could be wrong about that. I don't know anything for sure, but we have a 30% correction so far, and it looks like selling pressure has abated and we've run out of sellers at these prices. And now a liquidity crunch could still be ahead, and it could bring down gold a little bit further than it has already come. But the liquidity crunch is going to be so quick, because you'll see how quick it was even in 2008 and especially in 2020. It's only going to be a few days. And once it happens, we'll know that the next printing round is actually happening or around the corner or very, very soon afterwards. And that should print the dollar into oblivion and trigger the endgame that we've all been waiting for. Okay, first slide here we have going back in time to 2008. This was the 2008 gold correction / crash, and it might surprise you as to how it actually played out. So the first thing we had was we had a high in gold on March 17th, 2008, at $1,030. That was an all-time high in the gold price. And for 7 months after that, until September 28th, I believe it was. No, actually, it was a little bit later than that. It was in October. So the liquidity crunch, I think, is pretty much agreed that it started in earnest on September 28th, 2008, which is when everything started crashing. The Fed started moving on printing a bunch of QE, whatever it was. So we have here for 7 months, gold was predicting some kind of a liquidity event in the 7 months leading up to that event on September 28th. So we had a correction that was as much as 30% down here, but what's actually pretty surprising is that gold moved way back up, leading up to the immediate uh, preceding events to the September 28th liquidity event here. So for 7 months, I'm saying basically we had a 30% correction, as much as a 30% correction, but it re the correction corrected, meaning went from 30% to only down 10% by the beginning of October. So if we compare that to what's happening today, we see that we've had about a 30% correction over 6 months. 2008 was about a 30% correction over 7 months. So that does lend credence to my theory that we have a very possible potential bottom here at just below 4,000. And it doesn't look like gold is going any lower. It could possibly, I just don't think so. We'll see what happens. I'm prepared for either way. But if you look at these two charts from 2008, with gold on the top and S&P 500 on the bottom to line up the crash or the liquidity event with the gold price action at the time. You can see here that here we have in this box the liquidity event basically. This was late September when the S&P and all other assets basically just completely crashed. And you see here that leading up to that event, gold went up from about $740 to about 920. Gold had very much recovered, not completely, but going down only to a 10% correction from a 30% correction down here. During the actual crunch, you can see here this is the September 28th, going to the November 21st intermediate bottom here, at least in the S&P, right? You can see here the S&P going down here from about 1200 to about 750 or 850 or whatever it was. It was a very scary time. But gold only crashed for about 11 trading days. If you count these candles, which I did manually, it's about 11 trading days from the high here to the bottom in gold at $680 on October 31st. So this, I think, is October 10th. This is October 31st. That adds up to 11 trading days. It's 3 weeks, but it's only 11 trading days. And during that time, we had an intermediate bottom here in the S&P, but the liquidity crunch kept going until about March 6th, 2009, which is the bottom at 666 in the S&P 500. And during that time, gold surged way back up, almost old highs at above 1,000 over here. So what I'm saying is that gold only crashed for about 11 trading days during that liquidity crunch, which is not a very long amount of time here. So if we can bifurcate this, right, this is the gold correction leading up to the crunch. And here we can say is the bottom.
Rafi Farber believes the current correction looks remarkably similar to the market setups that developed before the 2008 and 2020 financial crises. His view is that if another liquidity crunch hits the banking system or broader financial markets, gold, and potentially silver, could briefly decline as investors sell assets to raise cash. However, he argues that these moves have historically been short-lived because central banks typically respond with aggressive liquidity measures. Farber points to 2008, when gold corrected for months before falling for only about 11 trading days during the worst of the financial crisis. Despite continued weakness in stocks, gold recovered quickly once liquidity returned. He also highlights 2020, when gold's sell-off lasted only around 5 trading days before rebounding strongly. Today's market continues to be shaped by expectations for Federal Reserve policy, persistent inflation, elevated government debt, continued central bank gold purchases, and ongoing geopolitical uncertainty. While these factors can create short-term volatility, they also remain key reasons many long-term investors continue to watch precious metals closely. Farber's core message is that investors should focus on the bigger monetary picture rather than reacting emotionally to temporary price swings. While no outcome is guaranteed, he believes any final liquidity-driven decline could be brief before the next phase of the precious metals market begins.
And here is the crunch bottom, which is a little bit lower, yes, but it's very, very ephemeral, very temporary. It doesn't last a long time. Now, if we look at what happened after the crunch, when asset prices continued to fall, as the S&P and all other asset prices continued to fall into March 2009, gold had recovered almost all of its losses during the second act of that crunch, or really, it's like 9/10 of the crunch. Because here's the very, very beginning, the first 11 trading days, and here's the rest of it going into March. And during that time, gold had recovered. So crunches only affect gold for just a very short amount of time until the Fed acts. And once the Fed acts, gold is first to move. That's the point. So we compare this to 2020 during the March 2020 liquidity crunch, which was brought upon by our genius health providers or health sirens. I don't know, idiots, whatever you want to call them, geniuses. I don't know if there's much of a difference between idiot and genius these days. Kind of the same thing. But during that time, gold crashed for about 5 trading days during that liquidity crunch from the top here to the bottom here. Only 5 days. So compare that to the 11 days of the crunch in 2008. You have a 5-day crunch here, and gold was the first thing to recover before other asset prices did. Way before other asset prices got to old highs, gold was the first to recover. And I think it's going to be the same thing this time. I would say that we are near, or we have already hit a bottom or an intermediate bottom in gold prices here. I don't think they're going to get much below 3,900 or something like that. We've already had a 6-month correction. That's pretty much what we had in 2008. And then in 2008, after that 6-7 month correction, we had a liquidity crunch, which brought gold down for 11 more trading days, very briefly, until the bottom at 680. And from there, it never got any lower than that. So yes, we could have a further liquidity crunch, which could bring gold momentarily down below these $3,900, $4,000 lows. But if it does, and we can see that it's being triggered by the banking system or something in the financial system, we'll know that the Fed is already acting, and this is going to be reversed. In 2008, it was 11 days. In 2020, it was 5 days. This time, it could be 2-3 days or even shorter. So I wouldn't fear the final liquidity crunch. It's going to be very fast because the Fed is already has its fingers on the money printing triggers. They know exactly what to do. They're going to start buying assets like never before, and that should be the end of the dollar. You don't want to be chasing gold while the dollar is hours away from oblivion. You want to have it now. So get your dirty man safe. Use code ENDGAME10 at checkout for 10% off. Get some gold positions and store some of them, not all of them, but some of them, maybe with Keith Weiner at Monetary Metals to earn interest on your gold in gold and silver terms, 100% backed, as always, with honest gold dealers like Monetary Metals, and pick whatever you prefer.
Whether Rafi Farber's outlook proves correct or not, the coming months could be critical for both gold and silver investors. Markets will continue to respond to Federal Reserve decisions, inflation trends, central bank buying, and geopolitical developments, making risk management more important than ever. Now it's your turn. Do you think gold and silver have already found their bottom, or do you expect one final correction before the next major rally? Share your thoughts in the comments below. If you found this analysis valuable, please like this video, subscribe to the channel, and turn on notifications so you never miss our latest updates on gold, silver, the global economy, and financial markets. Thanks for watching, and we'll see you in the next video.